Hey, this is Matt from Let's Not Be Fools, and you may have heard the term inverted yield curve. What is an inverted yield curve? Hopefully I can explain it. So let's take a look at the yield curve. The United States government borrows money from investors via the U.S. Treasury Department. The U.S. Treasury issues bills, notes, or bonds depending on how long they are borrowing the money for. So let's look at this graph here. On the x-axis I have years, and this is the bond length, how long the bond is issued for, that is how long the government is borrowing money for. And on the y-axis I show the rate of return of the bond or note or bill, whatever they are issuing. Now a normal yield curve is upward sloping, like that. And it makes sense. If you're only going to lend money to the government for 1 year, you would expect a lower return, as opposed to if you're lending money for 30 years, you expect a higher rate of return because you're locking in that rate and you're giving them money for 30 years, and that's a long time, and you want to be paid for that. Now the slope isn't always this dramatic or even this upward sloping. It could be a lot flatter, or it could actually curve kind of upwards like that, or it actually could curve upwards like that. But in general, you would expect to get a lower rate for the shorter amount of term that you loan the money to the government and a higher rate for the longer term debt that they issue. Now, an inverted yield curve is the exact opposite. It goes downward. Now, this is just for illustration purposes. They usually don't slope down like that in such the dramatic manner. But I just wanted to illustrate the fact that it's at some point in the curve, it's actually going down and it gets inverted. So instead of this, normally you would see an inverted curve like it'd go here and then it would dip down on a shorter term here and then kind of move up there. And that's the inversion right there. That's where it's getting inverted. In this example, a 10-year note is yielding less than a 2-year note. And that doesn't make sense, right? The longer the term you let the government borrow for, the more return you would expect. But in this case, you're getting 1% for 10 years, but you get like 1.5% for 2 years. That's the inversion, and that doesn't make sense. Now this may be inverted for a short amount of time. It might just be a few days or a few weeks, but a prolonged amount of time when this inversion occurs, that could be a harbinger of something worse, like the economy is getting worse because people are fleeing to these bonds. They're locking in this rate because they think the economy is going down, or they think the stock market's going down and the economy is getting worse. They're going to lock in these returns. Money is flowing out of the stock market into bonds, and people are snatching up these bonds right here for safety, and that's making the inversion happen. Now, one thing the Fed might decide to do is try to push down these shorter term rates so that this inversion gets unwound, let's say. So if they force down these short-term interest rates and they make this line down here, then it normalizes the slope of the yield curve where it wasn't normal before. It had that inversion. So that may be a tool in the Fed's tool chest to try to straighten out that curve, or actually make it upward sloping. They'll just push down the shorter term rates to make that slope a little more prettier for them. So I'm going to go to my computer and show you the action of the yield curve over the last few months. Here my graph is labeled Constant Maturity Treasury Rates, or CMT rates. So this is a graph representing all of the bills, notes, and bonds issued by the U.S. Treasury and what they are currently yielding in the market. So this is not what they are currently issuing them at in the market. This is the current yield. So on the bottom you'll see I have differentiated bills, notes, and bonds, and it just has to do with the length of maturity. So bills are issued everywhere from 1 month up to a year. Notes are 2 years to 10 years in length, and bonds are anything over 10 years. So yes, the U.S. Treasury will borrow money from you for 1 month if you like. So on March 1st, you can see that the yield curve was actually sloping upwards in a normal manner, albeit kind of a flat manner, but still it was upward sloping. So in the middle of March, you could see that the curve inverted a bit. You can see the 5-year note was actually yielding less than the 1-year bill. On April 1st, you can see the whole line kind of drop downwards, and there's still that inversion in the 2 to 5 year range. April 15th, the yield curve moved up a little bit, but there's still that inversion in the middle years there. On May 1st, you can see the inversion becomes a little more pronounced again. On May 15th, you can see it became very pronounced. You can see the difference between the 1 year and the 7-year and 10-year notes, how it dips down and makes that big concave shape there. And on May 30th, you can see that concavity still exists. The 2, 3, 5, and 7-year notes are trading at a rate that is less than the 6-month T-bill. So as I mentioned before, investors are flocking to these particular notes. There's fear that the economy is going to go into a recession. Now, will it? We don't know. Even though every recession has had an inverted yield curve indicated before it, it doesn't necessarily mean we're going to go into a recession or the economy is going to turn downward. This may be an indicator, but it's not a 100% indicator. There are times when the yield curve is inverted, even for an extended amount of time, but the economy does not go into a recession. So it doesn't necessarily mean we're headed into a recession just because we are facing this inverted yield curve right now. However, the inverted yield curve is an indicator that investors are expecting that rates are going to go lower in the future, and therefore they're locking in the higher rates that they can get right now. Keep in mind, an inverted yield curve is just a potential indicator of a future recession. It is not the cause of a recession. And also, it could be an indicator of a recession, but is not a predictor of when that recession is going to happen. A recession could happen 2, 3, 4 years down the line, well after the inverted yield curve has already occurred. I hope this video was helpful in explaining the yield curve and the inverted yield curve. And now at the next party, you can bring that up as a subject and sound really, really smart. And people would be like, wow, that guy's really smart, or that woman is really, really smart. So hopefully you enjoyed the video. Subscribe to my channel if you could. Have a great day.